Hey, audio good, video good? You guys see me? Perfect. There we go. Great. So this is the first time we get together in May. It's kind of crazy how fast this year is going. Uh, and it's funny. It's like each time we get together, I feel like it's kind of revolves around like a major like inflection point, or at least like that's kind of how it's lined up since the end of February. Um, it seems like every 2 weeks when we have these sessions, it really kind of like lines up with like kind of a major pivot or inflection point in like the overall market. Um, so for those of you guys that this is your first time meeting with us, um, I just I want to stress that like this is like open format. Okay. If you have questions at any point, just fire them off, or if you have comments at any point, just fire it off. All right, like there's I want these to be as helpful as possible. So, like don't feel like don't don't feel like you have to hold off asking questions, or like even if like something like that comes up in mind isn't like particularly related to what we're going over at the time. Like that's totally okay. Like again, like really, I want these to be as helpful, informative, as useful as is possible. So it's just again like an open format, like you know, bouncing ideas off of each other, going over certain things. So just don't hesitate to ask questions at any point. And these videos, so I'd like just like to remind, like these videos, they're all recorded and they're typically up on the T3's YouTube page under the options to play tab, typically by the following day, like the afternoon at the latest. So it just really depends on whether compliance is backed up or not before they can approve it. But it's usually by like the afternoon the following day at the latest. So if you want to go back and rewatch like tonight's session, I can say today because it's only like 1:30 in the afternoon here. But if you want to go back and rewatch this session or any of the ones in the past, if you joined just in the last like week or two, feel free. They're up there. They're at your disposal whenever you want. And if you do have any questions, maybe something we covered like a month ago, 2 months ago, 3 months ago, whatever, just shoot me an email. I'm happy to help if I can, like or hopefully clear up some question you might have if I can. If you stump me, you stump me. I can always Google. The worst case, if I don't have an answer to what you're wondering, I'll just Google it. And then if we still can't figure out, then we have bigger issues, right? Um, um, I guess the way I like to start things, just going over like general broad action in the market because it shapes it shapes our trades, right? I mean, like if we're in like a strong trending tape, like I'm not going to be banging my head against the wall like forcing like bearish ideas, right? And if we're in like a bearish tape, like in March, like you're not going to be like pounding the table like bull, 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 bull all over. So it's like I like spending time going over like what I'm seeing, what I'm looking at, because obviously like the trades I write up is based off of what I'm seeing and what's working, right? So um, we are in still within a trend. All right. I mean, basically, the March bottom has been up until this point, almost like a V bottom, right? I know there's a lot of people that are very opinionated whether we're going to have a V bottom, whether we're going to have a W bottom, whether we're going to have a U bottom. You know, they can. Everybody's entitled to their opinion. Right now, we are basically V bottoming. I mean, I think it would be a stretch to see us just kind of keep moving back to our high. Like that's my opinion. I think like that would be, considering like what's going on in like the economy in the country, like a V bottom seems um, a V bottom seems kind of aggressive. People expecting that, but I mean, as of right now, I mean, like that's what the charts are saying, right? I mean, we put in a bottom and we've basically been just moving higher since then, right? I mean, we're basically in a really strong uptrend off the low. So 8 EMA for a little while was support. We broke below that last week, and that's why I was saying like the last couple times we got together is like kind of like a pivot. So we broke below the 8 EMA on Friday, and even with today's bounce, we didn't get back above it. Now the 8 EMA, when we're in like a real strong trending tape, it's like the 8 EMA and the 20s. So the 8 EMA is the green and the 20s the pink. So let me get rid of this. So when we're in like a real strong trending tape, like those are like the two bread and butter moving averages because those really dictate the action. You have, the kind of like the combination of the two. The 8 is typically a higher floor, the 20, a little bit of like a floor underneath that. So you can see that we broke below the 8 and we held the 20. Now, if the uptrend is going to remain intact, you probably want to see some sort of demand like solidify in this area, and even potentially reclaim the 8 EMA. So that's at like 284.70. We got pretty close to it this afternoon. We didn't quite get back above it. But if we're going to kind of maintain this uptrend, I mean, like those are like the two moving averages I'm really focused on. And like again, I mean, we broke below one on Friday, and that's why I thought coming into the week was going to be kind of interesting to see whether the bottom held, which we have today, or whether we started to roll, which is still yet to be determined. But overall, I mean, action still. It seems like the easier money is still on the long side, right? I mean, last week was like frustrating for a couple of reasons. Not the least of which was you saw like kind of like the rotation days, right? Um, which I'll go over. Like I'm gonna go over that in like a few minutes. But what was frustrating about last week is that you saw like a pause in some of the leaders, and then you saw some of like the laggards play catch up, and the laggards were some of the best short setups like going into last week. So when you see like those break out and squeeze, it's kind of frustrating. And to me, it also kind of highlights that it's a little bit of like that rotation action going on underneath the surface. A lot of those names have since like given back the moves, which again, it's kind of frustrating. There was like some like last week was kind of like a roller coaster for me because there was some like really good action, and then there was also some really frustrating stuff going on. I don't know if you guys felt like the same way, but there was like some things were great, and then it was like really annoying to see like some like great bear setups just get blown up, kind of get like a squeeze, and then see them come right back, right? I mean, like that to me was like really frustrating. Um, but again, like to me, like it still seems like the easier and like a little bit of like the faster money is being made on the long side. So, uh, I'm trying to still have a pretty good mix of bullish and bearish ideas because I do think that again, like if we are within like a nice steady, well, not steady, but we're in a nice uptrend off the low, but all it would take would be like one like particularly bad down day to kind of bust that up, and then you start to see things open up to the downside. So um, what I've been doing is some like short term momentum bull ideas, right? Some like a little bit shorter time frame, more momentum driven bullish ideas, and then on the downside, like slightly longer term kind of ideas set up more like fading into resistance, right? Or maybe like some things that were hanging in like kind of like tight bear flags around their 52-week low. Those were like the patterns I was looking at, but really on the downside, like the time frame is a little bit longer than some of the names on the upside, and really like the thinking is that we're still kind of in that bullish uptrend. So I feel like bearish ideas or like put spreads or puts, right? You kind of need to give them a little bit more time because it could take a little bit longer to develop. Which is again like this is basically like the opposite of what we were doing in March, right? In March, a lot of the easy money was on the downside. I mean, things got absolutely crushed. But what we were doing was like shorter term bear strategies because the moves were playing out faster, and then we were kind of putting on some like longer term bull ideas, right? Like looking for like a bounce once things finally like recovered a bit, right? So like now we're basically just flipping the script to the complete opposite. So it's slightly longer term bear ideas because we're in an uptrend, and shorter term, more momentum driven like bull ideas. So, like June, July, those are some of like the bear time frames right now. And then like for like the bullish, still kind of like June, but maybe even like late May. Like I feel like if it's like a good bull idea, it probably should work soon. So in like the next like 2 to 3 weeks, and like that should be like the time frame for some of these like bull strategies. Um, and then you probably don't need me to tell you, but like Qs are still the best. Tech is acting the best. Whether it's big cap tech, medium sized tech, software, semis. Well, semis actually aren't that great, but like software, big cap tech, um, just some really great action. And you can see that. I mean, the Qs are like leaps and bounds better than basically any other moving average right now. They actually today they got back above the 80 MA, so that in and of itself kind of highlights the relative outperformance, right? But you also notice that they're above every other major moving average too. So, I mean, I feel like if you just read like the news each day, you kind of get a feel that like tech has just been where everybody's come back into with like a fever, right? Whether it's Facebook last week or like Amazon, Netflix, right? Like people are really stepping back in on tech. Um, what I was thinking, and actually kind of what I'm looking at, is to see if there's maybe a little bit of like sell the news or profit taking like after last week in some of these big cap names, because you had basically like every major tech name, like all the tech titans that reported last week. The numbers, I mean, you could really kind of pick apart the numbers on all of them, right? I mean, like not none was like a blowout by any means. Like the guidance wasn't great. Some companies just beat lower bars. So I was just what I was waiting and watching to see was whether like after like some of the euphoria wore off, right? Because you had a lot of like chasing going on, or that's what it seemed like to me. Now I'm waiting to see if you start to see some profit taking, right? And I like coming into this week. That's what I was watching, especially after the way Friday played out, where it looked like we might start to roll over a bit. So I was seeing if like Microsoft or like a Facebook, if that broke back, right? If like a Facebook broke back below like the 200 and started to like retrace a little bit, or even Apple. Recently, Apple's kind of had a history of moving higher on earnings and then kind of fizzling after, right? It's done that a couple quarters in a row. It's like pop on earnings and then fizzle. Well, actually, in November it didn't do that, but the 2 quarters before that it did. So that was kind of like my thinking, like people kind of piled into tech ahead of earnings, things got bid up, and then like the combination of, you know, like people profit taking, and then like I thought that the market looked like it could potentially roll over on Friday. Um, I was waiting to see if some of like these mega cap tech names start to cool off a bit, and that's really what I'm still looking at this week, is to see if some people kind of hit the pause button on them, just because they did a lot of the heavy lifting. Some of them are a little bit extended, and I was just wondering if those kind of cooled off in the near term, and if they did, whether something else picked up the baton, and if not, I mean, like that could be kind of like a signal that the trend is changing, right? What do you guys think? Any thoughts? I mean, you know, yeah, I think, I think that uh, they're all fantastic companies, and um, it's a tough, it's tough betting against them because they definitely get the most interest. So whether it's from mom and pop investors, whether it's from institutional investors, right? But also as you get like net inflows into like ETFs, right? Like so for basically every dollar that goes into the queues, right? Just based off the construction of the queues. So for every dollar that goes into like the queues, basically 45 cents of that is allocated to Apple, Microsoft, Amazon, Google, Facebook, right? So like the weighting is so disproportionately high in these that for a lot of like the passive funds, it kind of provides like this tailwind because like these are such like heavy weightings in like these ETFs. So it's very tough to bet against them. You got to pick your spots. And I'm not saying that they're bad companies by any means. I was wondering if because a lot of people kind of piled in over the last like 2, 3, 4 weeks into earnings, whether maybe you get like kind of like a near-term profit taking, kind of cooling off period on some of these. But we'll see. I mean, again, just that was my thoughts. Like I am definitely watching, and I think like the time frame on that is like June minimum, June, July, like sometime like like I may I don't know if you're gonna get like a serious move lower, but like June, July, possibly. But we'll see. It's like it's still up in the air, but that was something that I was thinking. But again, tech is definitely leading. The action's the best in tech. Again, whether it's like big cap software, semi's still got some work to do. You can see that the chip stocks are lagging a bit compared to some other areas. Um, but yeah, yeah, and we've had most of the semi reports too. So I don't know if there's going to be a whole lot of I don't know if there's going to be a whole lot of news flow there to get things going again. But we'll see. So the VIX, right? Still elevated. I guess our new normal is like 30s and 40s, so that's kind of wild. Forever, well, it seems like forever. Like our average trading ranges was like the mid to low teens, and now our like new normal is like 30s and 40s. So it, yeah, it the VIX is coming down. You can see, but I mean it's still like a mid 30s reading, and like that definitely impacts option pricing. So the prices like the VIX is lower, but it's still elevated. And I think what we've noticed so far this earnings season is that there's a lot of sectors that just really aren't in play, and the option pricing is just like ridiculously high based off of how March played out and the fact that the VIX is still high. Just what I've been noticing is that I mean, like some of these tech names are moving, and then you kind of get like a one-off name here and there that moves. But for a bunch of different sectors like industrials, energy, um, I don't know. I really don't know. Um, it's what was like the V? There was the VVIX, right? Was that what you mentioned last time, Russ? Or was it James? Hey, when you guys mentioned the VVIX, so it's like the volatility of the VIX. But to me, like it actually it actually it kind of makes sense that it's still this high, and um, I don't know what it'll take. Yeah, I mean I mean we've had like a really great move off the bottom, and tech again has been acting fantastic, but it just shows you that there's still like a really heightened level of fear. Still, it's like a palpable fear in the market that people are still ultra nervous, and I think that's like legitimate, right? Yeah, let's go back. Do it weekly. So this is a weekly. I can go back even further. So we want to do like a 7 day. So this is the financial crisis here. You can see how that played out. And then I guess from like the top, from like the high to when it broke back below 20, was almost 9 months, I guess. No, excuse me. Um, it was almost 12 months. So the high was in October 2008, October 2008, and then it finally broke back below 20 in like October, early November of 2008. So from like the high to when it was back below 20 was just about 12 months. Um, but I mean, I guess as of right now, it's kind of following a little bit of a similar path, right? Kind of topped out high 80s, taking a little while to get back. I guess at that time, like the VIX actually remained in like the 30s and 40s for about 6 months. Looks like, let's go back so you can see. Right, so the VIX it rolled over and then it did actually maintain like a pretty elevated level for a while, and then it started to roll again, and then yeah, it took about a full 12 months for it to break back below 20. So I guess if you look at what it did then, right, and then you look at what it's doing now, maybe like that's the time frame we're thinking, right? Like maybe like elevated for 5 6 months, and then you start to see like kind of like the slow burn below 30 into like the 20s, and then I mean like who knows what the end of this year is going to look like because we still actually have the elections, right? Which I know I feel like I feel like that's going to be like a whole nother. I mean like I mean the way it's playing out, I feel like people are already talking about the fall kind of being a little bit more uncertain because I mean that's people are people are thinking that it could pop up again once we get into like the colder weather. Um, but then you add in like the election and I mean kind of setting us up for like a busy finish to the year. But yeah, maybe like that's the time frame, right? It's like but 5 6 months for like elevated and then kind of like a steady grind lower after that. We'll see. But again, I mean, it really like the elevated VIX really impacts option pricing. I mean, whether you're selling premium or buying premium, right? I mean, like there's a lot there's a lot of very expensive options out there, and it's presenting opportunities, but you just got to really be like mindful of what you're paying for, right, or what you're selling if you're selling premium, which we're gonna I'm actually gonna talk about today. Yeah, 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 definitely. I mean, definitely, definitely. A lot gonna probably revolve around how the fall plays out, right? The election, I mean, the vaccine. I mean, hopefully, fingers crossed, we have a vaccine this year. I mean, that would be like best case scenario from what I'm reading. Oh wow, yeah, yeah. That's what. So like one of the things that's interesting that people. I, I so trading like deep out of the money options. There are obviously risks associated with it, right? Um, so like spiders, we'll talk about this just because it's kind of like interesting. Um, So like deep out of the money options, there's risk associated. I mean, they're deep out of the money, right? So like the first risk is that you're literally buying options that are 150 points out of the money, 160 points out of the money, right? Yeah. So they don't work out. But at the same time, if you buy deep out of the money options, you also don't need them to necessarily get you don't need the underlying to get anywhere near the the actual stock, right? I mean, or the actual strike of the contracts. It's so, like sometimes I like doing it just because like I take like these really low risk or like low debit contracts. I can buy like a bunch of them, and basically like not. like committing like a lot of like dollar investment to it, but like you said, like if you get like a sharp move quick, you could see like the implied volatility really jack up, and like yes, like they're not going to be anywhere near the money, but you don't necessarily need them to be near the money to make money on them, right? Like just let's let me pull this up. Go back here. Sorry, let me get rid of this for a sec. So yeah, let's just look at the sweaters. So it's like sometimes like when we're sometimes when we're in like those periods of volatility, you'll see like these really crazy like 30,000, 40,000, 50,000 blocks of like calls or puts that are like way 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 out of the money, and then like people's first reaction is like, oh, it's like what like there's no way that spider like 100 strike puts, like there's no way like spiders are going to hit the 100 strike, right? But like what these people sometimes what these people are looking for is just like a quick fast move. Like they're basically paying pennies on the dollar, and if you do get like a fast move, like like you said, like at the beginning of the time frame of that trade, you can see like really significant appreciation in those contracts, right? So like you were saying, like the December contracts on spiders, right? Like if you're looking at, let's just say like the 100 strike puts, right? So like right now, those 100 strike puts are trading for like 40. Let's say like 40 cents. You can see here. We'll just use like the midpoint, um, right? So like you're really not risking a lot. Like you're risking like 40 cents, right? But if the SPY was to drop like just say like 20 points in like the next month, right? Just using like the 120 as like a proxy, right? Because like they're not going to lose that much in time value because they're still pretty far out. But if the SPY were to drop 20 points in the next month, or even like sooner, maybe like the next 2 weeks, you're probably looking at almost like a double, right? Because the 120s are trading for about 80. And then, if you were to get a fast move, there should be plenty of time value. So, like, you could make the argument that these options could be looking at like a double, right? So you don't even need necessarily like the SPY to come anywhere near like the strike your contract. You could be looking at like a double just on like a 6-7% drop in the SPY pretty quick, right? So like I feel like sometimes like people kind of like look at those as like lottos. They buy them and they say like, oh, like this is going to be like my like catastrophe insurance, but you can actually like trade these and make money on them and like not hold until expiration, because again, if you have like the proper time frame and you catch the move quickly, like you can actually see the premium of these contracts really move quite a bit, especially on like a percentage basis. So kind of like low debit, you can buy a bunch because they're like low debit, only like some of them maybe only trade for like a few cents, and then if you get like a fast move quick, you can still have like a nice trade, right? Versus like having to like pay, if you bought like the 200 strike puts, right? So you bought the 200 strike puts for like 675, and it dropped 20 points, right? You'd probably only be looking at like say like 60, so like 2/3% return, so like a 65% return, versus like those way out of the money ones looking at almost like 100% return. So there's money to be made. I I don't like. I would prefer catastrophic hedges on like individual names, because I feel like um, there's there you can make more of an argument that like a stock could have like a 60-70% move, versus like it seems like it'd be a lot harder for like the overall market to do that. Um, and it also depends on the actual name. Like I feel like I feel like like a name like a name like Darden, right? This thing lost 80% in March, right? So like catastrophe puts would make more sense on like a Darden, than they probably would on like say like an Apple. Like Apple's probably not going to lose 80%, but like a Darden, something like that, right? And then I probably wouldn't be buying catastrophe puts and holding them till expiration on like the SPY, it would be like a trade. That's how I would approach it. Uh, yeah, but it's interesting. I mean, like there's ways to make money, especially you know, especially if you don't have like a big account, or maybe like you really don't want to like put a lot of like capital debit risk. You know, you can still participate in some of these moves. You just got to go further out of the money, and you got to manage them a little bit closer because you know the money options, especially if you don't have a lot of time, you're going to see your premium erode faster. But you know, there is potential there. Yeah, yeah. Well, that's why like you know I think some people right now are looking at them because you know they're expecting the fall to be volatile. You got the election too, which should like kind of introduce like a different level of volatility. And plus, you know, I mean, like, yeah, like, you know, I don't know what the market's going to do in 12 days from now, let alone 12 months, right? So, um, having like more time presents more possibilities. Um, so yeah, it's interesting. But like, you know, like you can kind of look at those ideas as more of like trades and not actually have to hold them until expiration. Any questions? You know, I was going to talk about oil, but I mean, we can save that for a different day. I mean, oil's just doing what oil's doing, which is either going up a lot or going down a lot. It seems to be like the average trading range on oil is nope. So on a debit call spread, your max loss is the price you paid. So if you know say you paid like $1.50 for call spread, right? Like you know you say you bought one call for three, you sold the other call for $1.50, then the max you can lose if those contracts expire worthless is $1.50. Yeah, your your risk is capped at the price you paid. So if you paid $1.50, the most you can lose is $1.50. Yeah. Anything like so like debit contracts are like net laying out money. Yeah. So that's why I like in the options and trade ideas, like they're all debit ideas. I won't do credit, even though like actually in like a minute I'm gonna talk about credit, but like credit strategies. But I stick to debit only. Um, I think for most people, um, it makes more sense just based off of maybe like you know their risk tolerance, like um, it, you know, I think credit, like selling premium and options, takes a lot of capital. It's very capital intensive because your risk is a lot higher. Also, I think you need to manage things a lot closer because it can kind of spiral out of control if you're not really paying attention and something moves against you. It can get kind of ugly pretty quick. So I think that I think it makes sense for some traders, but for majority, probably makes more sense just to stick with debit strategies. So like you know, premium paid is your max risk. Just quickly, yeah. Um, so so basically, all of the I mean, I like in the money can work. Yeah, I mean, I'm basically most of the time I'm looking for return profiles that are well, not most of the time. Like basically all the time, I'm looking at return profiles on the strategies that are at minimum 2 to 1, or I mean, if they're a swing trade, then sometimes I'll do a little bit less than that. But like basically, like I want minimum 2 to 1 risk reward, right? Just based off of like how many trades work, like so you basically need to factor in like the amount of trades that work. Like not everything is going to be a home run. On the flip side, not every trade that you lose on is going to be a zero, but like to like come out ahead, like like I want risk to reward profiles of the trades that are basically 2 to 1 or higher, right? So if I'm risking one, I want if I'm risking like $1, I want to be able to make like two, right? So when you go in the money, like generally speaking, like in the money, you're probably not going to get those same types of reward profiles. Your like your chance of success probably goes up, right? Because like the trade's already starting in the money. So your chance of it working could increase, but at the same time, you're probably not looking at like that same type of reward profile, right? You're probably looking at maybe like a 50%, like 40, 50, 60%, something along those lines. Hmm. Yeah. I mean, most of the time, um, I like options that are. So it depends. Like for like swing trades, I like kind of closer to the money. Maybe like I mean, it really all depends on the name. So for swing trades, like slightly closer to the money spreads. If it's like a catalyst trade, so like an earnings or event, something like that, I don't mind going out of the money because I have a higher degree of confidence that the stock is going to have a big move. So um, again, like there's risks associated with going further out of the money because if you don't get a big move, I mean, obviously the options are going to take a higher, uh, or they're going to get hit harder, right? But I have like around like the like earnings or events, like I have a higher conviction level that you're going to get a bigger move. So I don't mind going out of the money further because your risk reward profile increases, right? So if I'm going further out of money, I can get like something in the lines of like 3 to 1, 4 to 1, 5 to 1, something along those lines. But what you also notice with like the options and trade ideas is that I try to keep the debit of all of the ideas basically like 90% of the options and play ideas are between like the net debit is between like $1 and like $4. And that's because like I try to keep it in that ballpark because everybody's going to trade different size. But I want to keep like kind of like a defined band of the risk of the strategies that I'm writing up, you know, versus like going out and saying like, buy like one in the money Amazon call into earnings, that's going to cost what, like $20,000. Some, if it's going to cost like, I don't know, like, like 200, it's going to be like 200 points, right? So it's going to cost like 20 grand. Um, so, versus, and then say like, I'm going to buy like one in the money call on GE, which is like maybe like 60 cents, right? So like it just like the, the risk profiles get all kind of like skewed out of whack. So what I like to do is design trades. I mean, like I'll trade like all different stocks, but what I like to do is design strategies where like the net debit of those strategies lies somewhere like you'll notice like 90% of the trades lie somewhere between like $1 and like $4 is typically like the high. Most of the time it's below $4, but that's by design. It's try to keep it try to keep it in that window, and then people can determine how much size they want to risk on their own, right? Whether it's like 1, 2, 10, 20, whatever it is. But I try to keep it in like that specific window on purpose. But yeah, I mean, like there's not like a bad. I mean, like in the money options are, I mean, like they're great trading vehicles. You know, I mean, like there's plenty of money to be made on in the money, on the money. I mean, there's you know, I certainly wouldn't say like that like to avoid it by any means. I mean, it's just um, I'm just looking for like a specific reward risk to reward profile um, with the trades, and that's why I don't go in the money more often. Does that make sense? I mean, if you yeah, yeah, no, I yeah, yeah, yeah. It's funny. It's that's kind of like what I end up. I feel like a lot of like the spreads end up being like right in that same ballpark, Russ. I didn't know that there was a mathematical program that kind of highlighted that though, but I just feel like that's kind of like the sweet spot that I find too. Yeah, if you got an article on that, I'd appreciate if you could um, like forward it to me. I'd love to read about it. If not, no worries. I could do some digging and see if I can come up with it on my own too. Okay, so just very quickly before we get into before we go into the next thing here, just treasuries. Okay. Yeah, interesting. I'll check that out. I wasn't familiar with that. Hub profit source. Let's check that out. I made a note of it. I'm gonna take a look after we're done. So this is like this is just what I want to highlight quickly. You're starting to see like a bearish divergence play out in treasuries. So this is notable because I feel like bonds are starting to lag, and I don't know whether that's from exhaustion, where it seems to keep topping out here, or whether you're starting to see money move back into like risk assets. This is interesting because I mean there really hasn't been too long of a period this entire year when treasuries have really underperformed. I mean March was madness, right? But if you take out like basically like a week and a half stretch, right? So when you take out when it went parabolic and then when it collapsed, what you'll notice is that basically since the beginning of January, TLT has spent really like the entire year above either its 8 or its 20, right? So you had like this, you know, if you get rid of this and you get rid of this, then you'll notice that it's basically been the 8 and the 20, right? And now what you're starting to see is it's starting to lose both. And um, I, I don't know if it has like longer term implications, but it's interesting to me because this has been like a kind of a crowded trade. Uh, people long people long bonds, right? And I feel like if you start to see money moving out, that money's probably going to go somewhere else. So whether that's like stocks, gold, you know, like it's probably going to go somewhere. I mean, maybe to cash, who knows? But this was interesting, and it's starting to kind of develop. That's why what this is basically what I was looking at for like the TLT like put spread was I was looking at kind of like this A20 like how it's starting to crack, and you know it's not really rolling over too aggressively yet, but it's kind of like an interesting development that's starting to take shape. And again, I mean you can see like basically like the entire year. it's been spending above the 8 and the 20, and now it's starting to kind of lose both. And it could possibly have like implications for a lot of other things if money is starting to like move out of like the safe haven bonds, right? It could just be technical. I I don't know. I mean, like I you would think that if people are still nervous and they're worried about like if people are still nervous and they're worried about um, like a possible correction coming again, right? Like I mean, bonds should be acting stronger, but it's kind of like telling like a different story, right? I mean, you have stocks which are really rebounding, but bonds were really strong. Now stocks have cooled off a bit, but now bonds are starting to cool off a bit too. So there's a lot of like mixed like signals coming out. But I do think that this is worth watching because there have been stretches when TLT like big moves in bonds has really kind of like impacted just like trading in general. People kind of get spooked when there's like really big moves in bonds, but it's starting to kind of develop. It's not quite there yet, but if it starts to roll, I mean, there could be some room lower here. It's a pretty crowded trade, and it's really outperformed for a long stretch this year. But that's something that I just wanted to like put on the radar there. But again, that's why I like that June, the June put spread open is because this is what I was looking at, like this basically this break of the 8 and 20. It kind of hits like an air pocket, and that's what I was looking at to see if this started to like move more dramatically to the downside. Yeah, yeah, I got yeah, that's I mean like what I was looking at. A, you have like this gap, and then B, you got the 50-day. So it seemed like in either scenario, like the first major area of interest would be like 163 ish. So there's some room there. We'll see. It's still developing, but I just wanted to highlight that just to kind of go over what I was looking at. Huh. Well, that's good to know. Maybe the trading gods will shine on us favorably on this one. All right. No, perfect. Yeah. I mean, well, I mean, like, so, like, the way I look at it, the risk is basically like the 170, 171 area, right? Like, I mean, it has like a serious phobia of closing above 170. So, when the trade was initiated, it was like right at like 168. So, I mean, we have like a very clear level on the upside. If it gets above 170, 171, we can get out. But I mean, for right now, I like the way it's developing. So just kind of watching and waiting, letting it do its thing. Um, but I mean, this is what I was looking at, and then I mean that 8 and 20 was really significant to me. But I mean, you can tell like if this starts to get above 170, 171, I mean like that bear thesis is going to take a hit. So we can trade out of it. But I'm sure like those puts will have some premium at that point if it happens. Okay, let's hop into the lesson. Just because I've already been going for almost an hour here. Sorry. I can once I get going, I can just start talking. Um, but let's go over this, and then there's a couple trades I just want to talk about quickly. Oops. That's not what I'll do. So what I want to talk about is basically what I don't really the trade ideas I don't really write up. It's like credit strategies, and I I don't really like selling premium. Um, it's not it's not really a focus of mine, but I definitely acknowledge that in this market, especially around earnings, there's a lot of companies that have already guided, right? They've already whether it's they've given preliminary numbers or whether they're suspending forward guidance. It removes a lot of the volatility, but option pricing is still really high because March was crazy and the VIX is still high. So you're at a point where, for me, I like being long debit strategies into earnings, but you got to be very selective because there are a lot of stocks and options that are probably not likely to have a very crazy quarter, and option pricing is very high, right? So, I don't think it's a necessarily bad idea to be kind of like looking at like credit strategies around earnings right now. That being said, credit spreads, in my opinion, are a better way to approach it. Yes, you're not going to collect as much premium because you are capping, right? Or you're buying higher, further out of the money, like calls or puts to like cap your spread or turn it into a spread, but you're also limiting your risk, right? You've defined risk. Um, and um, I feel like when you have, just naked calls or naked puts, it's just, especially around earnings, like, yes, like maybe there's a lot that aren't going to move, but you still open yourself up to like that one-off scenario where maybe it's just like a horrendous report, or maybe it's like amazingly good and the stock moves 20, 30, 40%, right? I mean, it's not that uncommon to see those multi standard deviation moves around earnings. I mean, maybe this quarter you don't see as many on a week to week basis, but it still has the potential to happen, especially around earnings. So, like selling calls, I mean, the stock could theoretically keep going, right? Like you could have, I mean, theoretically, it could keep going up and up and up, and like your short calls are could be like really significantly painful, right? On the downside, your risk is the company going to zero, which probably not a very high probability of happening, but still, I mean, there's still a lot of risk. So um, credit spreads, if you're going to look at these types of strategies, credit spreads, in my opinion, are the way to approach it. So what what you're looking at with a credit spread is basically it's just the reverse of a debit spread, right? I mean, just very very basic. Like that's just before I like kind of go over like what I look at, but like just very basic. It's if you're paying for a long debit call spread or a long debit put spread, um, you're just looking at contracts that like your long contract is closer to the money, your short contract is further out of the money. So if you're looking at a credit strategy, it's just reverse. Like you're close to the money contract is sold and your further out of the money contract is bought, right? And again, that's capping your risk. So if you sold a $5, so like using like Russ's example from what he was talking about, like a $5 a 5 point wide call spread, right? If you paid $1.70 for it, your max risk is $1.70, right? Like that's a debit call spread. Now, if you sold a credit call spread, right, you collect that $1.70, and then your max potential loss is $5, right? So if the stock rips in your face and it goes way above the top end of like the strike of that credit call spread, then your max potential loss is $5. So you collected $1.70 and you lost 330. So you collected $1.70, you lost $5. So at the end of the day, your net is a loss of 330. But it's a lot better than had you just sold one naked call and the stock went up 20 points and you would have lost maybe like $10 or $15 instead of only $3.30, right? So again, so for what I like the benefits of debit call spreads, still kind of like the same idea of credit call spreads. So you can still participate, right, on those higher applied volatility, those higher price contracts, but you also have defined risk. So instead of being like theoretically unlimited on the upside and zero on the downside, at least you have some degree of like measured risk selling premium, right? Okay, so I guess like the basically what I wanted to like go over like mostly is just like if I was going to be selling premium, like 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 how do you know about how do you know which strikes um, and expiration, right? And because I mean, at the end of the day, like your main goal is to have the contract expire worthless. If you're collecting the premium, you don't want it to finish in the money, or you don't want it to finish, um, you know, basically like significantly in the money, right? Um, so what I like to do is kind of like it would be like one of two things, right? And this is similar to how I design calendar spreads because like the main idea behind it is kind of like similar. It's like you almost want you want to get like a contract that's close enough to the money where you can get like good premium, but you also don't want it to be too close to the money where it's like a higher probability of it closing in the money, right? Um, so the first thing I like to kind of factor in is the price to move. So this is going to be revolved specifically around earnings. So when you calculate the price to move, that basically generates like this really useful band that you can kind of walk off on the chart to give you an idea of what the options are expecting, right? And then um, that right there gives you like basically two levels that you could work with if you're looking at like a credit call spread or a credit put spread, right? So, for instance, like I'll go over an example and after like the last slide, but for instance, like if the price didn't move on, I don't know what reports this week. So like say Shake Shack, right? I think they were pricing at about 6 points. Now, if you thought that Shake Shack was not likely to have a very big move this quarter, then the price didn't move. So 6 points higher. So say it closed at 55 the day of earnings. 6 points higher would be 61, and 6 points lower would be 49, right? So what you could look at is like selling like a credit call spread right at the top of that priced in band, right? Because what you'll find is around earnings season, a lot of focus is on the priced in move, and then it's basically like that over underline on like say like a game, right? A lot of the focus on the over under is when it gets close to it, right? So it's like when you have like like a priced and moved band, then the people that sold premium are very focused on like so for instance on Shake Shack if it was 6 points higher, they'd be very focused on that 61 level because the higher it moves above 61, the more money they'll end up starting to lose, right? And then the people that are long premium, they're focused on a moving above 61 because then their strategy goes from like a loser into like a winner, right? So that's why I really like to use like that priced in band as like levels to focus on to be like either like a net seller or like a net buyer. So in this case, we're talking about credit, so like a net seller, right? Um, the second would be technical levels, all right? Um, moving averages, uh, support, resistance, so like 52-week high or 52-week low, monthly resistance, yearly support, monthly support, etc. Right? Because those end up being like really significant focus levels for traders, right? Like you'll see like stocks gravitate towards significant moving averages or significant areas of support. It's just it's it's like market dynamics 101, right? So if you're looking to sell premium, you could like design strategies so like a credit spread around those significant levels of resistance or support because you figure that the first time it hits that area there might be resistance or it might be support, so the stock is not likely to push through that level, right? So it's whether it's like a 20-day, 200-day, 50-day, or any of those moving averages along the way. I mean, like they can be really useful, like highlighting like key areas of resistance support that you can kind of line your credit strategy up with. All right. And then expiration. So like the tempting thing is to go further out because if you go further out, you collect more premium, more time value. But at the same time, um, your theta is going to be lower. So like the rate of the time value eroding is going to be longer. So when it comes to earnings, even though you won't collect as much premium because the time value really won't be very significant, I feel like short term makes the most sense. So like weeklies or maybe like even like 2 weeks out. Um, and that's really just because like those contracts, so much of the premium is tied into the implied volatility or the implied move of the earnings that there's not a whole lot of time value left. And if the stock doesn't have a significant move, or even if it does have a big move, like there's not going to be a whole lot of time value, and you'll see like the rate of decline accelerate a lot faster, right? So if you're looking at credit strategies, especially around earnings, like the 1 week to 2 week time frame is probably going to be more advantageous than like going further out like a month, 2 months, 3 months, because the rate of time value erosion is going to be a lot lower on those longer term contracts. Plus, like the further out you go, that opens up, there's higher possibilities of the stock making like a bigger move, right? Versus like over like a 5 day stretch or like a 10 day stretch, the possibility of a bigger move is lower, right? Any questions? I wanted to go over, just kind of go over what I a little bit more, or just go over what I mean in like these slides, like from like with like a visual example. Okay, so just I guess three stocks reported this week. Actually, so I still think what would be useful is to, if you, again, if you're looking at credit strategies, and I know that they're not for everybody, but this quarter in particular, I think it's interesting just because you have so many companies that have got it early, right? So I think those names that got it early, especially if option prices are still really elevated, like those would be some of like my names that I'd be more interested in going at, because guidance, whether it's preliminary numbers or forward guidance, I mean like the lack of guidance is really going to hurt the possibility of like a larger move. So like I'd be focused on screening for the names that have already guided, and if you're thinking about credit strategies, those would probably be the ones I'd be looking at. This week you have two kind of like bigger ones, Pinterest, PINS, right, and then Roku's another one, right. So just like using like Roku, so it's a little bit. Well, let's use Pinterest, right? So this one lines up a little bit better. Roku is kind of like a crazy stock, and there's like a in between levels. But so what I was like talking about with like the technical moving averages, right? We'll talk about the price to move. So Pinterest is looking for it's pricing in about let's say two about 275. Okay, so about 275 is what's priced in on Pinterest. So what you could do is like look at like like a credit call spread that's maybe like $3 out of the money, right? Because like that's right outside the priced in band, or like a credit put spread that's like $3 below, right? Because if it's priced in 275, then if you go like $3 out of the money, then you're going to need like a significant move to for that strategy to move into the money, right? And I like to use the price in bands as kind of like a gauge of like how far out of the money I want to go, or I would go, right? Or with Pinterest, because it lines up kind of nicely, is you have like these really great moving averages, and the stock is kind of like sandwiched in between, right? So you could say that the 200-day sitting above, probably likely to be a huge area of resistance when it hits it, right? I mean, you can see that when it reported back in February, significant gap traded through the 200-day, but closed back above it and closed back below it and never retested it, right? Or on the same side, you could say that the 100-day on the downside could potentially be like an area of support, right? Because it was support earlier in April, and it's a significant moving average. If you want to go further down, you could say like the 20 or the 50 day. So what I like to do is like use those as kind of like areas of interest, right? Saying that the 200-day could be resistance. So if I'm looking at like a credit strategy, I could design it using like the 200-day as like the strike for that strategy, saying that the 200-day could be an area of resistance, right? Or if it's a credit put spread, it'd be like using the 100-day, right? Because the 100-day could provide support for the stock, right? So that's what I meant with priced in bands, right? Using like the priced in move, so walking 275 off on the upside, walking 275 off on the downside. That gives you an idea. So you could use that as like the levels where if you're looking to sell premium, use those. Or if the stock lines up well and there's like significant moving averages or significant areas of support or resistance, you could use those as kind of like helpful gauges of where like or which strikes you want to target and where you want to like do like your credit strategies. Okay. No, so the straddle is pricing in 275. Yeah. So the at the money weekly straddle is pricing in 275. So what I do is I mark off 275 to the upside, and then I mark off 275 to the downside, right? And that would give the priced in band. And the reason I do that is because so people that are net long the straddle, they need a $2.75 move in either direction, right? Um, Obviously, if you pick the direction, if you're just only bullish or if you're only bearish, then the amount of movement you need changes. But like the way I approach it and the way most people approach earnings is that it's like a battle between what's priced in and what the stock move is, right? So if 275 is the straddle, then I mark off 275 to the upside and I mark off 275 to the downside. And anybody that's long the straddle is going to need to move in excess of 275 either way. So like those would be 275. So like if you're at 3 on the upside, and if you're at 3 on the downside, those would be levels where I feel like it's still interesting because they're close enough to the money where they should have a decent amount of premium, but they're also far enough out of the money where it's going to require a larger than expected move to move into the money, right? That's like to me that's kind of like the sweet spot. And then whether you want to go further out or closer to the money, I mean that's going to depend on how aggressive you want to be and what your risk parameters are or what your risk tolerance is. But like to me, like sitting right at the priced in band is kind of like the sweet spot, or maybe just like right around that priced in band is the sweet spot because the premiums should still be relatively high, but also at the same time, it's going to require a significant move above what the option market is anticipating. Um, there probably is. I don't. I'd have to like look up and see what it is. Um, I mean, there's got to be. There's a statistic for everything, so I feel like there's got to be a statistic for it. I don't know. I don't know what it is. Um, but yeah, I mean, there has to be, right? I mean, it seems like somebody has the data. They could probably calculate that. But that's why. So that's why like to me like I'd be focused on those names where they've already given guidance, right? Because like that to me like I think one of like the largest the largest volatility around earnings typically happens because of guidance. It's not the quarter necessarily. because it's backward looking, right? I mean, yeah, if a company misses like for the quarter, it could be a surprise, but if they raise guidance, you've seen it plenty of times, right? They maybe have like a lackluster quarter, raise guidance, the stock rips, or they have a strong quarter, they cut guidance, the stock crashes, right? So the guidance is significant in terms of creating volatility around earnings. So if companies have already guided for the quarter and or already indicated that they're not going to be guiding for the year, then that to me removes like a significant portion of the potential volatility, right? So that's why I'm saying like if I was looking at credit strategies, like to me like those names would be more interesting because premiums for the options are still high because the overall trading ranges on the stocks are still high. The VIX is still high, so that creates higher priced options in general. But if there's not going to be any really significant volatility from guidance, then it's kind of like a bad combination for a debit strategy, and that's why I think like credit could make sense in like those instances. I'll take a look. I'll take a look. Yeah, I again, it also it really like it depends on what sector you're looking at too. I mean, like some sectors just really don't typically move a lot around earnings. Option prices in those cases aren't going to be very elevated, right? Um, I mean, there's just tech and biotech and healthcare and a lot of those areas, the higher beta stocks, right? Their option prices are going to be more expensive, higher implied volatility because they tend to have sharper reactions to earnings versus like some industrials or like REITs or like even like banks, right? They're not typically volatile. So if you're selling premium, yeah, stock probably won't have a very big move, but at the same time, you're probably not collecting as much. So your risk might be lower, but your reward's also lower, right? So you're kind of weighing you're weighing the risk to reward. Like the risk is lower, but also the reward is lower. And for some people, like the risk being lower is probably more interesting to them, right? Well, versus like some people they want a bigger reward, so they're willing to take on a little bit more risk. So it kind of depends what works for you, what sectors you're going to look at. But again, I think the names that have already guided and or suspended forward guidance, like those would be the ones where I feel like option pricing could end up being too high. So like those would be the ones I'd be focused on. Like for instance, last week in Starbucks, right? So Starbucks reported here. So this was Starbucks earnings, right? So going into earnings last week, I think Starbucks was pricing in like 5.5 points, and to me, it seemed unusually high considering Starbucks just guided like a couple weeks ago, and they basically said that they're not going to be guiding for the year. So not only was there really no uncertainty around the quarter, there really wasn't any indication that they were going to give the year guidance to really move the needle much, right? So option prices were basically looking for a move more or less in line with what it's moved in the past on earnings, whereas there really wasn't the expectations of like a volatile print because they've already guided, right? I mean, I think that day, what was it? Starbucks ended up moving what $2. It's pricing in 5.5, ended up moving like $2, right? So that was one to me where it like there was like a serious there's a serious disparity between what the options are pricing in and what like the potential of the stock to move indicated, right? So that's kind of like the setups I'd be looking at. It's like stocks that already guided for the quarter, already got or suspended guidance for the year. where you're looking at still elevated option pricing because they still are technically reporting earnings, but at the same time, the potential volatility is lower. Yeah, so I would say around compare it to I would say I typically don't go back much more than like 3 quarters. I give a lot of recency bias uh, to the stock's behavior around earnings. So like 4 quarters, 5 quarters, 6 quarters ago, like less relevancy to me than say like last quarter or the quarter before that. So like the last 2 to 3 quarters, I I give like a higher weighting um, to me factoring in like what the expected move could and should be, right? So like that's typically how I approach it. Is like the last 2 to 3 quarters, and then I compare that to what's priced in, and then again, like right now we're in a higher volatility environment, so everything's going to be a little bit elevated, and especially after the way March played out, probably have to factor in even a little bit more on top of that, right? Yeah. So my general rule though is like the last 2 to 3 quarters, and then anything beyond that, like 4 to 5 to 6 to 7, like I give less of a um, importance to that. So for instance, like if you see, um, I can like nothing comes to mind, but like say last year. So say like the last say like 2 years ago and at the beginning of last year, some stock was absolutely crazy around earnings, right? And it was moving like 10, 15, 20% on an earnings report, right? But over the last 2 to 3 quarters, like that stock has really like been less volatile, right? And it was only moving like say like 5% or 7%, right? And like coming into this quarter, you see the option pricing kind of in line, right? So say for like 2 years ago, it was moving like consistently 15, 20%. Over the last 2 to 3 quarters, it was only moving like 5 to 7%. Option pricing is somewhere in the middle, say like 10 to 12%. Then to me, the option prices would probably, in my opinion, be too expensive because they're priced based off the historical movement, but recency bias says that the stock has been less volatile around earnings, right? So the last 2 to 3, it's only moved 5 to 7%, and options are pricing in 10 to 12%. So I would say that those options to me seem overpriced. And again, I mean, like this quarter is a little bit tougher because you have a higher VIX. You have had an absolutely crazy March and April, so the overall trading ranges are higher. But generally speaking, like that's kind of how I look at it. Does that make sense? Yeah. And then on the flip side, it's the opposite way, right? So maybe it's like it was like a boring stock for like 2 years ago, but then all of a sudden it's come into play, right? And it went from moving five. It went from moving 5 and 7%, 5 to 7% on earnings 2 years ago. The last 2 to 3 quarters, it's been moving 15, 20%. But yet the options are only pricing in 10 to 12, right? Because they're based off the historical movement. Then to me, like that I would say that those options look underpriced because recency bias says the stock is more volatile versus what it was doing 2 years ago. So those would be things where I'd say like options look underpriced. I prefer to be long premium into it. Um, yeah, we went over a lot. Sorry, I kind of kept you guys late again tonight. Um, Almost 5. Well, I don't. I mean, I guess you guys are all over the place. Some on the some East Coast, some Central, some West Coast. Got Hawaiian time over there too. It's up to you. Like if you guys want to wrap it up, we can do that here. Or if you want, I can go over if you want to go over like some setups for this for earnings this week. Or if there's like a swing trade you want to go over. Um, but I definitely hit a lot of the points I wanted to cover. Yeah, I mean, is there anything you want me to like go over, or you want to like a trade you want me to talk about? It's really like yeah, so like a lot of the points I wanted to hit, um, did. So it's kind of like if you have any questions or you want to like break down something, go over some earnings this week. Yeah, cool. Okay, yeah, yeah, definitely, Russ. Have a great week. Stay well. Good luck trading. Aloha. Um, my highest conviction idea right now. My highest, I think my highest conviction idea right now is long gold and the gold miners. That to me seems I don't necessarily think it's going to scream higher in the near term, but I think gold and the gold miners look very good. I like the way they're acting. They have technical to me it's positive technical indications, positive fundamental indications. I mean, like the GDX literally is doing exactly what I want it to do, right? Like, I mean, like this is if you could draw up the perfect scenario, this would be it, right? So it broke through like this 7 year level of resistance. It's forming a higher base, very measured, very methodical. Uh, it's yeah. If you could if you could you know if I could see this kind of keep moving steadily higher the way it is, um, this would be. I mean, it already is. It's playing out well, but I really like the way like this is setting up because it has parallels to what gold did when it finally started to go. Right? See the gold turn, break out, and then you had the extension and the leg up. Now, if you look at GDX, right, starting to break out, and I mean you can see that there's plenty of room to run if it really wants to start going. So I really like the way this is setting up. I like I like GDX specifically, but I mean gold too looks good. It's hanging where it needs to hold, right? Forming a higher base, right? I mean, if I go to like a daily chart of GDX, you can see what I mean, right? So 30, like say like 30, 31, right? So it formed a higher base above 30, broke out. Now it's forming another higher base. So yeah, I'd say like that's my highest conviction trade. Again, like I don't necessarily think it's gonna go screaming higher immediately, but the way it's playing out, the way it's shaping up, I mean, like this is breaking out of like a 7, 8 year resistance range. Very methodical, very measured. Dust. Yeah, I mean, like those triple double leverage things, they're definitely good trading vehicles. Um, you have to be very particular with your entrances and your exits because Um, yeah, well, they changed they changed the I think they changed the structure of those. Same thing with like JNUG and Nugget. So these were for a while triple leverage, but then when they collapsed in March, they changed them to double leverage. So you didn't have like the same risk. But um, you can see like I mean like this is the double leverage bull, right? So this is the double leverage bull. So this is why like yeah it's hard to be involved with these. Like this is the double leverage bull, and then this is just the your normal miners, right? Like I mean like they're just completely different patterns. So that's why like those double or triple leveraged vehicles like they're good for trades, but I mean for like longer term swings, I just there's too much at risk. There's too much risk in like the double and triple nature of them. So I prefer just focus on like the standard ones. But yeah, I mean for like a specific trade, like if you're looking at like a week, 2 week, 3 week time window, like I think those things can be viable. But for like a 1 month, 2 month, 3 month, it's just different story. Yeah. Um, yeah. So the action area is basically the entrance area. Yeah. And the way the action area works is that it's essentially so when at the close of trading on the night that I write up a trade idea, Chase, um, I basically walk off like a kind of it's kind of like a band. Like the action area is basically a band around where the cost of that strategy closed the night the trade was written up. So um, so say it was like a call spread, right? And like the night that I wrote up the trade idea closed at like $1.50. The action area would probably be like $1.75 to like $1.25. So something in that window, just because acknowledging that stocks move overnight, right? Options move overnight. So if I gave like a 5 to 10 cent window, then have to be like constantly adjusting it because it would be either above or below, almost guaranteed off the open. So kind of give a little bit wider window. That's like it won't alter the risk reward parameters that much. So the action area is basically like the entrance area, right, where the risk reward still kind of stands and it lines up with the original trade idea. And um, what yeah. So what the way I usually approach it is if it's like a if it's only like a bullish swing or a bearish swing, like if it's like directional, um, I usually like to wait like 15, 20, 30 minutes to get involved um, off the open, just because letting the books fill out because options can be a little bit thinner versus like a stock off the open. So I usually like to wait like 15 or 20, sometimes 30 minutes if it's like really volatile before entering like the swing trade. Um, if it's like um, if it's like a straddle or a strangle, um, I oftentimes wait until the end of the day to get involved with those. So like after like 2:30 p.m. is when I would put on like a straddle or strangle. Just the reason being that I don't want like I don't want the stock to have like a huge move during the day. So I don't want to open like a strangle at like 10 o'clock in the morning and then have the stock have like a huge rally during the day. And then all of a sudden going into earnings after the close, like the strangle has been like completely like blown out of whack because maybe like the all of a sudden like the call is in the money and the put is way out of the money, right? Then like the risk to reward has been completely skewed to the bull side, and say like the stock disappoints and it drops. It drops like 10%, but then it just basically gives back what it made during the day. So then like it's like again like you're like the things are all skewed out of whack, and the move is like back into the middle of your strike. So yeah. So long story short, if it's like a straddle or a strangle, I usually wait until after 2:30 in the afternoon to put those on. And if I make adjustments, like I usually send them out right around that time. So if I have to like change the contracts, then I'll send out an update to let everybody know. Yeah. Any other questions? I really like I like the pattern. It's not the easiest stock to trade. I was messing around. I was messing around with some like weekly lottos last week. It didn't want to go. I thought with Amazon reporting. Yeah, I thought with Amazon reporting that it was going to trigger like this little bull flag here. That's what I was looking at. You got like this little bull flag going. So I thought with Amazon, if Amazon was good, like this thing could take off. It just didn't want to go. But I guess like I would still um I'd be positive. I'd be cautiously positive. Let me put it that way. Because I mean it is Latin America, so I mean it's not the exact same thing, right? There's you know I mean obviously there's differences between Latin America economies and the U.S. economy. Also, like sometimes like foreign exchange can wreak havoc with it. So there's different nuances to that business than say like an Amazon. But like overall, I mean, I think it looks really good. The numbers, like the top line has been really consistently good. Sometimes the bottom line's a mess, but like the revenues have really been great. Like the stock to me is like a pretty explosive setup. It just it doesn't do a whole lot of volume. Options don't really do a whole lot of volume, so it can be a little bit tougher to trade on a day-to-day basis. But yeah, I think it looks really really good, and it kind of flies under the radar. Yeah, I mean there's been some really big moves in the past around earnings. So here, here. Actually, I'm not sure if I don't think you guys were members of Options and Play then, but this was a massive trade for us. This was we caught the breakout this quarter. This move. This was fantastic. It's back. This was like a 100 point pop on a Melly that quarter. That was a good setup. Um, we were in it on that one. But yeah, I mean yeah, like I like the setup. I mean I'll definitely be looking at it. I don't. I was trying to figure out if I was going to write it up for like an options to play idea, but I was looking at it over the weekend. I don't. I mean, like I think the option prices would have to come down to make it work. Um, we'll see. I mean, I might have some like lottos on it in like my own account. But in terms of good, but like again, like those are lottos. I mean, they're like higher risk out of the money stuff. For like an options to play trade, like it. I mean, I think I need to see the option prices come down a bit to get involved. Plus, like it's kind of tough because the spreads can be really wide on the contracts, so it can make it kind of challenging to get in and out. So that's sometimes if you see me like in it on my own, but I don't write it up, it's because sometimes the option prices or the risk might be too high, or like the contracts don't really trade well, right? Like sometimes it just doesn't make sense to like have everybody look at it when like contracts have like a $4 spread. It's like lunacy. But I might get involved in it on my own. But yeah, I think it looks great. That's why I was hoping for the move. Very, very, very tricky. Yeah, yeah, it looks good. Yeah, of course, of course. All right. Yeah. So I'll adjust those routinely. I still think I still think the contracts stand. Yeah, they still the queues are the queues had a little bit quicker of a bounce, but um, they still stand as like hedge ideas. And what I do is it's typically when it comes to like the SPY and Q. Um, so like those are always I like basically for the last 2 years I've maintained at the top of like the position list Aspire SPY and Q like um, put spread, and they basically act as like hedge ideas. So it won't they don't say hedge ideas, but that's how I operate them as like hedge ideas, um, and it's it's the way I like to do it is at minimum 2 months out. So like once the expiration period gets within 2 months to expiration, I will adjust them, or I like to adjust them. Unless we're in like a really crazy volatility environment, then I might let them go a little bit further. But um, it's typically like once we get within 2 months until expiration is when I'm going to adjust the hedge, and just like constantly rolling. Um, like there will almost always be SPY and a Q hedge open. I can't remember off the top of my head if there's actually been a period over the last 2 years when there hasn't been. So I try to always maintain it's some SPY, some Q put idea for people to kind of use as like a hedge idea. And then once it gets into 2 months, so um, after we get through probably towards the end of May, I will look at adjusting those the SPY and the Q, unless the volatility is like super high and things are crashing again. Then I might let them go a little bit longer. Um, but yeah, it's usually about like the 2 month window to expiration is when I start adjusting those. But that's why I maintain those at the top, because those are like put hedge ideas. How are the positions ranked? Um, yeah, yeah, of course. Yeah. Thanks for participating, James. I appreciate it. Thanks for stopping by. Um, on the you mean on the position list, Joel? Um, so so you see like the date added there, right? You can see the date added. So the ones that are the oldest are at the top, unless they're like unless they're a roll, um, and then I just then like the roll date will be adjusted. just overnight. Oh, VTF. Oh, sorry. I thought you were talking about. I thought you were talking about the options and play positions. Oh, um, so it goes by it. So during the day it goes by when it was open. So like if it was like adjusted, if it was open or adjusted, it moves up to the top, and then overnight it sorts by number of contracts. So during the day, it's like time adjusted, and then overnight, it's the number of contracts. So when it starts off in the morning, it's like the number. It doesn't go by like dollar amount. So sometimes I have like a bunch of like, well, it's just number of contracts, right? So like sometimes I'll have a lot of like 5 cent contracts, right? So it's not necessarily like dollar amount. It's just the number of contracts. Yeah, could have like 50 like calls that cost 5 cents. Like it's not going to be as much as like having like two calls that cost like $5 each. Yeah. But then during the day the VTF sorts by like the time added. So newer positions, newer positions, newer positions move up during the day. Like they're sorted towards the top. Yeah. No, it doesn't go by yeah, it's just the number of contracts, and it's the same thing with like equities. So I don't really hold equities, but like if you see somebody's equities, like the way they're sorted, it's by the number of shares, not yeah. So like from like a position list, if you see, it's like the same idea with like stock. So if you see like stock if you see like Redler's like positions, right? He's got like 5 stocks. The stock at the top is going to be the trade with like the highest number of shares. So it doesn't mean that it's the highest dollar amount. It just means that that's the highest number of shares. All right. Does that help? Cool. All right. Well, I think that's a good place to call it quits for the evening. Um, Yeah, thanks. No, thank you guys. Appreciate you sticking around. Went pretty late tonight, but we had a lot to cover. So yeah, and I mean, like, if you have any questions about anything we went over tonight, you just want to like shoot me a personal email. Feel free to reach out. If you have any questions about that just pop up during the week, again, like feel free to reach out. Like you have my email, or if you just want to like reach out to like your contact at T3, they always forward it to me. So, whether it's like a option question or a trade question, like I'm happy to help. Even if you just want to like bounce something off of me, that's cool. Um, so, yeah, hoping for some good trading this week. Best of luck. If you guys are playing anything, stay well. Right. Hope you and your guys' family stay healthy. Hopefully, we're closer to the back end of this. And yeah, have a wonderful trading week. All right. Talk to you guys soon. Have a good night. See ya.